Welcome to the Real News Network. I'm Greg Wilpert in Baltimore. The trade war between the United States and China continues to heat up. On Monday, stocks dropped globally, with the S&P 500 index dropping by nearly 3%. Also on Monday, China allowed its currency, the yuan, to drop to an 11-year low of less than 7 yuan to the dollar. Trump reacted by calling China a currency manipulator and saying that the U.S. will ask the International Monetary Fund to take unspecified corrective measures. President Trump tweeted the following on Monday morning: China dropped the price of their currency to an almost historic low. It's called currency manipulation. Are you listening, Federal Reserve? This is a major violation which will greatly weaken China over time. A few hours later, Trump tweeted the following: China is intent on continuing to receive the hundreds of billions of dollars they have been taking from the U.S. with unfair trade practices and currency manipulation. So one-sided, it should have been stopped many years ago. China's reaction to the accusations was swift too, saying that it will stop purchasing U.S. agricultural goods. China is the fourth largest purchaser of U.S. agricultural products after Mexico, Canada, and Japan. All of this is happening in the wake of a 10% tariff that the Trump administration slapped on $300 billion worth of Chinese imports last week because no agreement could be reached with China on how to reduce the trade deficit that the U.S. has with China. Also, China did not want to comply with U.S. demands for changing its intellectual property policies. The new tariff is in addition to a 25% tariff that Trump already had in place since April on $250 billion worth of goods. Joining me now to discuss the implications of these latest developments in the U.S.-China trade war is Bill Black. Bill is a white-collar criminologist, former financial regulator, and associate professor of economics and law at the University of Missouri, Kansas City. He is also the author of the book, The Best Way to Rob a Bank is to Own One. Thanks for joining us again, Bill.
Thank you.
So let's start with the accusation that China is manipulating its currency. Would you agree with that assessment? It seems that from most reports, China actually temporarily stopped propping up the value of its currency and let it drop to more or less market values. What do you think about all this?
Yeah, so when Trump says someone should have done something about currency manipulation years ago, guess what they did? The U.S. Actually brought this as a designation as a currency manipulator. And that was when China was actually probably manipulating its currency. And it largely ceased to do so. To the extent it was involved at all in doing things, it wasn't reducing the value of the currency. It was keeping it, as you say, slightly artificially high. They removed that support, and it sank closer to what people think is probably a market rate. And indeed, China promptly indicated that it would prevent further significant fall. So, as Krugman says, Trump has managed to find the one area of trade abuse that China is not doing, and claiming that that's what their abuse is.
So, how would lowering the value of the Chinese yuan help China, and why is Trump actually even upset about it?
Okay, so of course Trump says it will hurt China to devalue its currency, and you should keep that in mind because in another tweet the same day he said that Powell, the chairman of the Federal Reserve, had failed us again by failing to, wait for it, manipulate the U.S. dollar. By lowering interest rates so that we would lower the value of the dollar. And this is the competitive race of devaluation to see who can export more, which Trump says will hurt you. So why we would want to engage in a long-term race to hurt ourselves is beyond me. Why China would want to do it, if it really was going to hurt it, is beyond me. And to cut through all of this, this is all the general Trump insanity. You recall his quotation, Trump trade wars are easy to win. Well, no, particularly if you take on somebody kind of like your own size, like China, which has a very proud, very nationalistic record, as you would expect. And they say, F you to all of this and say, you want to hit us, we'll hit you back, and we'll hit you back harder, and we'll hit you back in ways that hurts you politically. And so Trump is in the middle of this infinite loop that periodically screws up the markets.
Now, I guess that the key is, though, that lower the value of the yuan makes it easier for China to continue exporting to the United States because then the tariffs don't hurt as much. Is that correct?
The tariffs hurt us, right? So when we put a tariff on, again, Trump can't get the most basic things right. That's a tax. When we put a tax on ourselves, that hurts our consumers. That's A. But B, simultaneously what's happening in the markets, the reason they're so upset is not just the trade war, but because the yield curve is inverted. And there's a past show where I explained what all of that meant. But for now, what's important is that's the not certain, but best indicator that a recession might be coming. And so one of the things that increases the risk of a recession is a tax increase, which is precisely what Trump is doing.
And according to this analysis that you're presenting, how long or how far off would a possible recession be? I mean, how long does it take to take effect, especially in light of the consideration that we're facing a presidential election in 2020, and of course, Trump's possible re-election will, to a large extent, depend on how well the economy is doing.
Right, and the answer is we don't know. How soon an inverted yield curve produces a recession can vary. We can tell you this. The yield curve is now the widest it's been since spring 2007. Anybody remember when that recession started? Officially, it started in 2007. So that's Trump's concern because there's inverted yield curves, not just in the United States, but in Japan and through most of Europe. And a number of European economies have slowed greatly. The US has slowed. Japan has slowed. These are many of the world's largest economies slowing. Who's left? China, the one he's getting into a fight with, and raising taxes. So that actually increases the risk of recession instead of the other way around. This is literally a case where there is one economist in the world that agrees with Trump, and of course Trump hired him, is Peter Navarro, and everybody else thinks he's an absolute kook.
Explain, though, for our viewers very briefly, if you can, what an inverted yield curve is exactly.
Okay, so an inverted yield curve is when you have longer term government securities, like 10 years in this example. Normally, the government has to pay us a higher interest rate to induce us to buy those 10-year bonds than, say, 90-day treasuries. And the reason is there's increased risk over the 10-year period of inflation. And bonds fall in market value when inflation goes up. Right? So that's normally why a yield curve is positively sloped. The longer the maturity, 10 years versus 90 days, the higher the interest rates. When a yield curve inverts, the opposite occurs. Short-term interest rates are actually higher. Long-term interest rates are lower. Well, why would that be? The rational reason that would be is because people are anticipating a recession, and recessions lead to sharp falls in interest rates in those circumstances. So in the long run, they're anticipating not inflation because we'll have a long, strong, greatest economy ever, but because we're near the precipice and more likely to go into recession.
Now, returning to the U.S.-China trade conflict, China announced also, as I mentioned in the introduction, that it will no longer purchase U.S. agricultural goods. Now, the federal government is already providing billions of dollars to U.S. farmers to make up for the lost markets in China. Now, if this complete stop of U.S. exports, agricultural exports to China happens, now, does that mean that these expenditures would have to increase? And what does it mean long term? I mean, could the U.S. be losing Chinese agricultural market forever if China ends up finding providers elsewhere?
Forever's a long time, of course. So, but in the intermediate term, absolutely. If you start trade relationships with, hey, guess who else produces soybeans? Canada, right? Uh, uh, then it can be very hard to get those back for the U.S. producers. On top of that, this is connecting with global climate change. So I'm in Minnesota and I teach in the fall in Kansas City, and my wife works here. So I do a lot of driving on I-30 between Kansas City and Minneapolis, which is to say the grain belt of Iowa, Missouri, and Minnesota. And the catastrophic flooding combined with China banning U.S. imports, you have massive amounts of grain, soybeans in particular, that is rotting in the fields. And so it's a huge loss. And the Trump strategy is first we stab the farmers in the back, and then we say, but not to worry, we'll give you transfusions. But of course, we won't restore anywhere near as much as we're taking away from you. So farmers are going to be weakened. Some of them obviously will blame it on whatever Trump claims is the problem. But farmers are actually in the modern era quite good business people, and a number of them understand that they're the ones absolutely getting screwed in the United States by the Trump tariffs.
Okay, well, we're going to leave it there for now. I'm speaking to Bill Black, Associate Professor of Economics and Law at the University of Missouri, Kansas City. Thanks again, Bill, for having joined us today.
Thank you.
And thank you for joining the Real News Network.
Hey everyone, my name is Arooj Sheikh, and I'm the Development Campaign Manager at the Real News Network. If we're going to stand up to the corporate elites, then we need your help to make people-powered media. And that's why I'm asking you to please donate to the Real News Network. And while you're at it, hit the subscribe button. Thanks so much.